Hello, ORAT Nation. This is Dan Bird here again, reporting in midweek. Just to do a quick update, let you know what I've been seeing and how the market's doing. We have been heading higher, but this week we've kind of gone sideways. I'm going to show you a few charts to show you where things are and what I think where we might be headed, and then take it or leave it, depending on what you would like to do. So let's start off with, let me share my screen here. Let me start actually with my newsletter. If anybody's interested in receiving this every week, I do this for free. Just send me a note to breakpointtrading@gmail.com and I'll add you to the list. I'll send you last week's newsletter and add you for the future ones that are coming up. As you can see down here, we ended January 6.18% higher, which over the long run, according to Stock Traders Almanac, when we have a good January, we typically end higher for the year. And you can see this puts us in quadrant 1, which is at the top quadrant. 2023 is the number 9 out of 74 years. So very, very positive. And typically the rest of the year ends up about 15% higher, which would put us at about 4,700. For the full year, in a year like this, on average, puts us at 23% higher, which also, if you take the low or take the close from the start of the year, that would put us also at 4,700. So both of those give a projection of 4,700 by the end of the year. Who knows if that'll happen? It doesn't have to. Certainly it could go down as well. Those are averages though. So theoretically, it actually could go higher than that even. I've seen some that have said 5,000 potentially, and I think there is a chance we could get to 5,000. I actually think we are still in a secular bull market, so I think this market's going higher for the next 3 or 4 or 5 years at least, with these little cyclical bear markets in between, which is what we're in and coming out of right now. So if you want to join my newsletter, there's no charge, and if you want to get taken off, just let me know and I'll take you off. No problem. So let's look at the sectors and see how the sectors did so far. This is today. I'm going to take a look at the full week. So 1 week, here's what the sectors look like. I have the VIX, the 10-year Treasury in here as well as the NASDAQ 100, the Dow, and the S&P. So if we look at a 1 week view, you can see the VIX has been slowly moving higher, which implies that the market will go lower. At the same time, the 10-year has been moving higher too. So both of those things are not necessarily good events for the stock market. So I think we're probably in a sideways or slightly down this week. Next week is the CPI number on Valentine's Day. And I think the market is waiting to see what that is. I'll talk about that on Sunday, what that looks like. But you see here, technology and communications are at the top, near the top for sectors for the week. Those are aggressive sectors. Financials also is looking pretty good for the last week or so. So all of those are in very good shape. At the bottom are the consumer staples, materials, and utilities, which are typically the value or the less aggressive sectors that typically do well when the market's going down in bear markets, but not as well if the market is starting to go higher. Discretionary is another aggressive sector that I'd like to also see move higher as well, but that one for the week is actually down a little bit. There's another way you can look at this if you're using stock charts, and that's by looking at a relative rotation graph. So this shows you what this looks like in a relative rotation. This is a 1 week over a 1 year period, but it's a weekly graph. I'm going to remove the S&P, the NASDAQ, the 10-year Treasury, the Dow, and the VIX, just to clean it up a little bit and show you just the sectors. And then we'll update this so we get a little bit bigger view. I'll actually make this bigger here for you as well. So this is what the rotation looks like. So this is, again, over a 1 year period. It's comparing it to the S&P. It's a weekly chart. And the way this is organized is everything on the right-hand side are the momentum components, or I'm sorry, everything on the left side of the graph are the momentum components. So as it moves from the bottom to the top, it gains more momentum. And the x-axis across the bottom is the relative strength. So what's the relative strength? As it moves more to the right, it has more relative strength. So what you want is something that's moving up and to the right naturally. So you can see energy here, which has been lagging lately, is moving down. It's weakening. It's still on the right-hand side of the graph. So it has relative strength still, but it is weakening. And then all the other ones are the utilities, industrials, healthcare, staples, and financials. Those are all the less aggressive sectors here. Again, moving down. On the right-hand side, you can actually see utilities is this one. Utilities is this one right here. So if I want to highlight utilities, it shows me this one. It's really funny because this one started to gain strength and all of a sudden it just reversed and started to go down instead. So if we look at the other ones, add those back in, and you can see that the aggressive sectors are starting to gain more strength moving up and to the right, especially things like technology gaining a lot of strength. So it's now in the improving quadrant, and we'd like to see it move over into the leading quadrant, which it looks like it's headed that way. And then the XLC communications is also moving up very strongly, moving up. So it's got big momentum and it's moving very strongly over into the leading sector. This is where the internet stocks are, and they've been doing really well lately. So overall, the market is looking really good as far as the aggressive sectors moving up. The VIX is still looking good, but looking like it's starting to creep back up again. So I mentioned that before, that it's starting to come back up to the 20 area. So that indicates that we might have a pullback, which we're due for a pullback anyway. So I'm kind of expecting to see that. We're getting a pullback, and these are the 10-year Treasury down here is starting to move up. It's above 3.5% now. So that's not good for the market in general if that's moving up, but I don't think it's going to continue. You can see it's starting to roll over anyway. I think that's going to start to move back down later on. The put call ratio is low, which means there's a lot of people buying calls rather than puts. So the sentiment in the marketplace is bullish, but I think we're probably due for a little pause right now. This is the graph that shows the Fibonacci levels as well. 4,300 is a really important one. I expect us to probably hit there at some point in the next month or so, and then probably go sideways from there. I think when we hit around 4,600, which is this peak over here, that's going to make the decision of which way the market's really going to go for the rest of the year. So we're heading higher. That's good. We've broken out. We've made a higher high. Now we're starting to pull back a little bit, which is healthy for the market. This is the S&P. I'll give you a little better view of what it looks like. So we broke out of this downtrend line. We're now in an uptrend, but I think it would be probably a healthy thing to come back to this 21-day moving average, which is around 40.50, and we could come even a little bit below that. So we'll see what happens. The market actually wants to go higher, so there's still a lot of strength that might push it up, but traders might be waiting for that CPI report next week. Now here's a 60-minute chart. So this gives you a much closer view of what the S&P looks like. So over the January, you can see January is right here. It's just been moving up ever since the beginning of the year. We had a little bit of a retracement here, came back down to the 200. And now we're starting to come back down a little bit to 4,100. 4,100 was a really key level. We finally broke through it, and that's what gave us our higher high. We're probably going to come back and test it. We tested it once right there and went up and made a lower high. Remember, this is a 60-minute chart, so it's a very short time frame. So I would not be surprised to see that break through this. If it doesn't, if it bounces here at 4,100 and starts to trend back up, that is very, very strong. So we'll see what happens here in the next week or so. Again, the CPI number next week might be keeping some traders out to see what happens with that. This is one that I showed last week, and last week I showed that we were in the 3x ATI, average true range. So the average true range was 3 times the normal way up here, and usually when it gets up that high, you get a retracement back to the mean. So the mean is here at 40.50, like I mentioned before. I would not be surprised to see it come back there and then start back up higher again. All of these things are starting to roll over, so that might also be an indication. Now, the market being as strong as it is lately, traders might be waiting for a retracement like this and might not even wait for it to get back to the mean and start to buy before then. So we'll see what happens, but I think the CPI number next week on Tuesday is going to help a lot of traders stay out of the market. This is a longer term chart. This is the S&P, kind of with some colors that show you on a long range view. This is the downtrend line that we started in the beginning of 2022. And you can see when the market fell, this is the 21-day and a 50-day, or I'm sorry, a 21-day and a 200-day. The red is the 200. So when the market fell through that, that was a clear signal to get out and step aside. And now we're back starting a little bit of green over here on the S&P. And if we look at this on the NASDAQ hasn't even posted any green yet, but the NASDAQ is what's been the strongest. So I expect that technology is going to lead. Technology, communications, and discretionary are going to lead the market higher and probably take us back up to the highs by the end of the year. But we don't go straight up in a straight line. And you can see we've gone pretty straight up since the beginning of January. So we're due for a pullback. I wouldn't be surprised to see it come back a little bit. Over here, 40.50 is where that 21-day is, where that little bit of green is. And the 200-day is at 39.50. I don't think we're going to get that low, but you never know. We could. And then the last thing I want to show is VectorVest. And the typical chart on VectorVest, if anyone uses VectorVest, I encourage you to listen to the daily updates that they post. It's only about 10 minutes long, and they go through all the charts and what they're seeing with the market. With VectorVest, you can see here the pullback, and it's a pretty solid red candle, which means the selling started at the beginning of the day, and it pretty much went through the rest of the day. You can see all of this is starting to roll over. Here's the confirmed up signal that was given back here on January the 9th. It was a pretty good signal to get in. I want to show that what's usually the early signal, which is called the due, but in this case, it happened a day after the confirmed up. But I like this one because it's been very reliable. You can see the down signal over here. And before that, it was an up signal all the way up through here. So it's very reliable. It's a great place to start. You know, put your list together for stocks that look healthy and things that you want to buy. But as soon as you see a signal like this, that's the time to get in. Be aggressive and get in right there. Right now, we're kind of topping and rolling over a little bit. So again, I wouldn't be surprised to see us come back to here. The MACD down below, which gives you an early signal a lot of times, is just getting ready to roll over and go beneath the 0 line. If that happens, then it's an early warning that probably the sell signal might be the next thing to happen. Now, a sell signal here, or on this due, the sell signal cannot happen until the price gets below this 30-day moving average and the DPO down here gets below 0. Now, this below the 30-day could happen pretty quickly, the next couple of days even. But getting this down below 0 is going to take quite a bit. It's going to take a pretty aggressive move down in order for that to get below 0 and give a sell signal. So what I probably am expecting to see is for this to trade down a little bit more, and we'll see what happens next week with the CPI number. And that could be the catalyst that sends us one way or the other. It could be the catalyst that sends us all the way down to the other side of this envelope right here. So that's it for tonight. Just wanted to give you an update on what I was seeing. Be careful. I think caution is advised right now. However, I think that we are in a new uptrend, and it would make sense to buy dips if you're in stocks already. and you're a long-term holder, certainly don't sell. If you're a short-term trader, then you might want to raise your stops or move to cash and wait to see what happens, especially with the CPI number coming next week. I'll talk about that more on Sunday and what I'm seeing there. But that's what I'm seeing right now. So good luck trading and have a happy week. Take care.